Welcome to the Nifty Noon Podcast. Imagine looking at a computer screen that explicitly warns you, like right in your face, if you click this button, you're going to instantly vaporize $50 million.
And you just go ahead and click it anyway.
Right. You click it anyway, and the system just executes your command flawlessly. I mean, the math runs perfectly, and your portfolio is just absolutely decimated.
It's wild, but that exact scenario is what kicked off one of the most whiplash-inducing weeks we've seen in modern financial history.
Yeah, it really was. And if you're joining us for this deep dive into the daily dispatches from our newsletter, the TLDR of the week really points to one dominant theme.
Oh, absolutely. The unstoppable collision and really the convergence of TradFi and DeFi.
Exactly. Traditional finance and decentralized finance. These two massive ecosystems, they aren't just, orbiting each other from a distance anymore.
No, they are actively merging. Like right now, they're becoming a single financial stack. The pace of structural development we're seeing, it's just staggering.
It is. We are way past theoretical frameworks at this point. We're dealing with hard, immediate realities.
And the timeline of how this unfolded over the past few days, which we documented in our newsletter, it really provides a masterclass in market evolution.
Right. So the mission today is to take you on a chronological journey through these dispatches. We want to start by examining that massive decentralized trading disaster on Monday.
Because that harsh reality check perfectly set the stage for what happened later.
Exactly. It set the stage for traditional financial giants to swoop in and validate this exact same blockchain infrastructure by Friday.
Yeah, it's a crazy arc.
Okay, let's unpack this. We begin on Monday, March 16th. Basically, a brutal lesson in permissionless finance.
Yeah, brutal is the word. The core story here is a single crypto whale losing nearly $50 million in just one transaction on Aave.
One transaction. And the mechanics of how this unfolded are vital for you to understand.
Right, so this user attempted to swap 50.4 million USDT for the Aave token.
And they did this using a mobile interface, right?
Yeah, a mobile interface. And the trade was routed through the CowW swap aggregator. And the thing is, they didn't break the system.
No, the system did exactly what it was mathematically obligated to do.
Exactly. And this is where we have to look at the underlying mechanics of automated market makers, or AMMs.
Because $50 million is a massive order.
It's completely disproportionate to the available liquidity in that specific routing path. The AMM relies on a constant product formula.
Right, so as the available Aave tokens in the pool are being aggressively drained by that huge influx of USDT.
The algorithmic price of the remaining Aave tokens basically approaches infinity.
Wow.
Yeah. The pool doesn't care about external Oracle prices. It doesn't care about fiat value.
It just cares about the math.
Right. It only cares about maintaining its internal mathematical balance. So to fill that massive order, it simply has to offer a catastrophic exchange rate.
And the crazy part is, the mobile interface actively recognized this mathematical reality. It wasn't hidden.
No, not at all. The app flashed these severe, bright red warnings indicating a 99% price impact.
99%. And the user literally had to manually check a confirmation box acknowledging this extreme risk.
Yeah, they had to bypass the guardrails, click accept, and they walked away with just 324 Aave tokens.
Which is worth roughly $36,000. Out of 50 million.
And the rest. The remaining 50 million was just instantly devoured by MEV bots and arbitrageurs who were scanning the mempool for that exact kind of spread.
It's the equivalent of your GPS explicitly warning you that a specific route drives you directly off a cliff.
Yeah, perfect analogy.
Right. The screen flashes, warning, cliff ahead. You check a box that says, I accept the cliff,
yeah.
And then you're somehow shocked when your car hits the water.
Well, what's fascinating here is that the immediate reaction from the broader public was to just assume it was a smart contract exploit.
Oh, of course. People always assume a hack.
Right, but Aave founder Stani Kulachov and the CowW swap team, they had to come out and publicly clarify that, no, the protocols function securely.
This is that double-edged sword of pure decentralization we always talk about. Code is law.
Code is law. The smart contract just executed the parameter it was given. The user accepted the slippage tolerance, and the MEV searchers simply balanced the pool back to parity.
Capturing that huge delta as profit. But I have to ask, why do we tolerate an infrastructure that allows for this level of unmitigated self-destruction?
Well, the industry is actively maturing to address that very question. Like, right now, Aave is attempting to contact the user to refund the transaction fees as a gesture of goodwill.
I mean, that's nice of him, but it's just the fees.
Right. The $50 million is gone. But the more structural response is the deployment of something called a Aave shield.
Okay, what does that do?
It introduces a hard-coded guardrail that automatically blocks any swaps with a price impact exceeding 25% by default.
So we are shifting away from a pure buyer beware environment.
Exactly. Moving to one where the UI actively prevents catastrophic user error unless, some sophisticated multi-signature override is engaged.
That makes sense. But despite that massive user error on Monday, the sheer volume of capital entering the space didn't even flinch.
No, it didn't slow down at all.
Our newsletter noted that BlackRock's staked Ethereum ETF, ticker ETHB, pulled in $15.5 million in volume on day one.
Which is huge. And Polymarket's short-term prediction markets are maintaining a blistering $60 million in daily volume.
So the utility is clearly there, even if the edges are still sharp.
Yeah, but here's a contrast. While decentralized code executes flawlessly, even to the detriment of the user human run, centralized crypto entities are still relying on opacity.
Oh, to hide massive structural failures, which is the perfect pivot to Tuesday, March 17th.
Right.
Because if Monday showed us the danger of highly transparent automated code, Tuesday reminded us of the absolute devastation caused by opaque, centralized companies.
We're talking about BlockFills here.
Yes, BlockFills.
Huh.
A major Chicago-based institutional crypto lender officially filed for Chapter 11 bankruptcy in Delaware.
And the fallout here is messy. It involves a $75 million loss, completely frozen customer assets, and a U.S. federal judge actually issuing a temporary restraining order over allegations of commingled funds.
Commingled funds.
Yeah.
Always commingled funds. And the scale of this collapse is what makes it significant to you as a listener.
Right. This wasn't a small shop.
No. We are talking about a firm that facilitated over $60 billion in institutional trading volume in 2025 alone. They were a titan in the lending space.
And yet they go under for a $75 million hole.
Exactly. So, I mean, are we simply trapped in a loop here? Are we just repeating the exact same catastrophic mistakes of previous crypto winters where centralized lenders gamble with user deposits?
Well, if we connect this to the bigger picture, there is a fundamental difference in how the broader ecosystem is digesting this collapse compared to previous cycles.
How so?
Because fleshing out over-leveraged or poorly managed actors is actually a necessary market feature. It's not a bug. When a centralized entity commingles funds, they create this massive duration mismatch between their liquid liabilities and illiquid proprietary bets.
And they rely entirely on the fact that depositors cannot verify their real-time on-chain reserves.
Exactly. They operate in a black box until the bankruptcy courts are literally forced to pry it open.
So the market is forcing transparency.
Precisely. The consolidation we are seeing now actively paves the way for a more resilient institutional infrastructure.
Yeah.
The surviving entities are being forced by the market to adopt the very transparent on-chain proofs that DeFi uses natively.
And the data absolutely backs up that flight to transparent quality. I mean, while BlockFills was locking down customer assets on Tuesday, the decentralized perpetuals exchange Hyperliquid was boom.
Oh, their numbers were insane.
Yeah. They generated more protocol fees in a single 24-hour period than Solana, BNB, Ethereum, and Bitcoin combined.
Just massive volume.
Capital is actively migrating away from those centralized black boxes and into decentralized verifiable state machines.
Even OpenSea delaying their SEA token launch felt symptomatic of centralized models kind of struggling to maintain their footing in this shifting landscape.
Totally. And the removal of those centralized bad actors is exactly what signals to traditional finance that the foundation is finally stable enough to build upon.
Which brings us to Wednesday,
March 18th. With the ecosystem cleansed of a major over-leveraged player, the biggest TradFi institutions on the planet began acquiring the underlying infrastructure.
Right. Mastercard announced a historic $1.8 billion acquisition.
$1.8 billion.
Yeah, which includes $300 million in contingent payments. And they acquired a London-based stablecoin firm called BVNK.
The magnitude of this cannot be overstated. I mean, this transaction officially eclipses Stripe's $1.1 billion buyout of Bridge.
Making it the largest stablecoin acquisition in the history of the digital asset industry.
But here's where it gets really interesting. Mastercard is not dropping nearly $2 billion to speculate on token prices.
No, not at all.
They are acquiring BVNK's infrastructure to seamlessly integrate on-chain stablecoin settlement into their massive global network.
Specifically targeting B2B transactions and cross-border remittances across more than 130 countries.
It is the equivalent of a legacy postal service outright purchasing the Internet's SMTP email protocols, because they finally concede it is a superior mechanism for data transfer.
That analogy strikes right at the core of the technical shift. Traditional cross-border payments rely on the archaic correspondent banking system.
Which is so slow.
It is. Institutions are forced to maintain Nostro and Vostro accounts. They're essentially pre-funding massive pools of local fiat currency all over the globe just to facilitate these cross-border flows.
It's wildly capital inefficient.
It requires multiple intermediaries, and it settles in days. But stablecoins, moving on cryptographic rails, they bypass that entirely.
They settle almost instantly.
Atomically, and for fractions of a cent. Mastercard's acquisition is an objective validation of stablecoins as a fundamentally superior architecture for moving global value.
But the timing is what stands out to me. Like, they could have attempted this acquisition a year ago.
True. But the catalyst is the shifting regulatory landscape. Our sources highlighted the recent passage of the Genius Act, which finally provided a legislative framework for these assets.
Finally.
Furthermore, Wednesday saw the SEC issue a new interpretation release clarifying the application of federal securities laws to crypto assets.
Right. Because when you are a publicly traded behemoth like Mastercard, you cannot deploy $1.8 billion into a regulatory gray area.
Exactly. You require unambiguous clarity.
And that clarity is unlocking development across the board. Another key detail from Wednesday's newsletter was the Phantom Wallet receiving a first-of-its-kind no-action relief from the CFTC.
Which is a huge deal for retail.
Yeah. It allows a non-custodial wallet to connect users directly to regulated derivatives markets without needing to register as an introducing broker.
The runway is basically being cleared for builders to connect retail users directly to institutional liquidity.
And that infrastructure bridge operates in both directions, right? Not only does it allow TradFi to purchase crypto infrastructure, it allows crypto to start absorbing traditional financial assets.
And that dynamic absolutely defined Thursday, March 19th.
It really did. S&P Dow Jones Indices officially licensed the S&P 500 to a platform called Trade XYZ to facilitate 2047 perpetual futures trading directly on the hyperliquid blockchain.
This is wild. For nearly 7 decades, the S&P 500 has stood as the defining benchmark for global equities.
Yep.
Seeing it officially licensed for on-chain derivative trading is a watershed moment. And we saw Hyperliquid's token, HYPE, spike to $43 on the news.
The technical implementation is what changes the game for you and me. Eligible non-U.S. investors can now trade leveraged positions on the S&P 500 continuously.
247.
We are so heavily conditioned to accept that the stock market opens at 9:30 a.m. and closes at 4:00 p.m.
Yeah, human hours.
Right. Why should your ability to react to a massive macro event, say a sudden geopolitical crisis or a banking failure that breaks on a Saturday morning, be locked behind a 9-to-5 schedule dictated by human brokers?
This raises an important question about the modernization of market structure. Traditional market hours are basically a relic of the telegraph era and the physical limitations of human floor traders.
Totally.
We operate in an asynchronous, always-on global economy now. By launching an algorithmic perpetual contract on a decentralized ledger utilizing Oracle networks to continuously feed the index price and funding rates to maintain the peg, you entirely remove those artificial temporal barriers.
But the matching engine doesn't need to sleep.
No, it doesn't.
And the contrast in market momentum on Thursday was stark. Our sources noted that traditional crypto exchange Kraken was simultaneously freezing its multi-billion-dollar IPO plans, citing difficult market conditions.
Right, while fully decentralized venues are capturing enough liquidity and momentum to officially license Wall Street's crown jewels.
It is a clear passing of the baton from centralized intermediaries to decentralized infrastructure. Which brings us to Friday.
The grand finale of the week.
Right. Everything we explored, the hard lessons in UI guardrails on Monday, flushing out opaque centralized lenders on Tuesday, the billions poured into stablecoin settlement on Wednesday, and licensing legacy assets on Thursday. It all culminated on Friday with the ultimate structural merger.
Friday, March 20th, the Nasdaq pilot program.
Yes. The SEC officially approved a pilot program allowing eligible participants to trade and settle certain traditional equities in tokenized form via the Depository Trust Company, or DTC.
And the eligible assets here are significant. It includes Russell 1000 stocks alongside ETFs tracking the S&P 500 and the Nasdaq 100.
The API architecture here is the critical breakthrough, though. These tokenized equities will share the exact same order book and execution priority as their traditional counterparts.
Yeah, that's the magic of it.
So let's break down how that actually functions for the listener. How do these two separate worlds share a single order book?
Okay, so the Nasdaq Central Matching Engine is designed to ingest standard protocol messages from traditional brokerages.
Right.
Under this pilot, the DTC acts as the bridge. It recognizes a tokenized asset on a distributed ledger as a valid digital representation of the underlying equity.
Okay, I follow.
So if you purchase a tokenized share of an S&P 500 ETF on the blockchain, and an institutional investor buys a regular digital share of that same ETF through a legacy Bloomberg terminal.
Both orders are routed into the exact same central matching engine at Nasdaq.
Exactly. You maintain identical shareholder rights, identical pricing execution, and identical priority.
Wow.
The only difference is that you are choosing to settle your trade via the cryptographic rails of a blockchain rather than the slower, traditional clearinghouse processes.
The blockchain is actively plugging into the mainframe of Wall Street.
It really is.
Yeah.
And to provide some objective context based on our sources, this tokenization push is gaining aggressive momentum, partly due to a potentially more favorable regulatory posture under the Trump administration. Yeah, exchange operators are feeling emboldened to modernize their settlement layers. However, the SEC's approval was highly measured. They explicitly emphasized that these tokenized pilot assets remain entirely subject to all existing federal securities laws.
So the format changes, but the regulatory obligations remain intact.
Exactly.
Well, we have established new guardrails, both technologically with Aave Shield and legally with the SEC pilot. But even outside of strict finance, this convergence is accelerating.
You're talking about the baseball news.
Yeah. Friday's newsletter highlighted that Major League Baseball officially named Polymarket as their exclusive prediction market exchange partner.
Backed by a first-of-its-kind memo of understanding with the CFTC.
It's everywhere. The underlying technology is quietly absorbing every layer of data and value transfer.
We are literally witnessing a fundamental replumbing of global commerce.
So what does this all mean for you listening? When you zoom out and look at the trajectory from a $50 million decentralized error to Mastercard deploying billions to Nasdaq clearing tokenized equities, how should we contextualize this week?
Well, the most critical skill in analyzing these markets is separating the noise from the signal.
Let's define the noise first.
The noise is the short-term volatility. The noise is the sensationalism of an individual burning $50 million due to a bypassed interface warning.
Or the chaotic bankruptcy proceedings of a centralized firm like BlockFills.
Exactly. Those events are dramatic and they dominate the headlines, but they are transient. They are just the friction generated by a rapidly maturing industry testing its boundaries.
And the signal.
The signal is the permanent infrastructure being installed. Mastercard integrating stablecoin settlement to bypass correspondent banking, and the SEC authorizing Nasdaq to settle traditional equities on a distributed ledger. That is the true paradigm shift.
So what should we watch next?
Moving forward, the key metric to monitor is how rapidly other legacy networks like Visa, massive Tier 1 banks, and international clearinghouses begin adopting these tokenization rails for their own back-end efficiency.
Because that back-end integration is the wedge that drives global mainstream adoption.
Right.
It is incredibly reminiscent of watching the internet evolve from fragmented, highly technical message boards in the 90s into the invisible backbone of all global communication.
Exactly. You eventually stop thinking about the protocols entirely, you just use the applications.
Precisely. Which leads to a final structural puzzle to consider as we wrap up this week's deep dive.
Ooh, what's the puzzle?
Well, we now have traditional equities capable of settling instantly on a globally distributed ledger, accessible 24 hours a day, 7 days a week, completely bypassing traditional localized brokers.
Right.
If that technology scales to its logical conclusion, what happens to the very concept of a physical stock exchange a decade from now?
That's a great question.
If the ledger is universally distributed and the matching engine is entirely digital and global, do we even need Wall Street as a geographic concept?
I mean, probably not.
The geographic concept of Wall Street simply evaporating into a decentralized cloud. That is a massive paradigm shift to leave off on. Thank you for joining us on this deep dive into our newsletter.
Thanks for listening, everyone.
If you want to stay ahead of the curve and receive these insights as they happen, make sure to follow Nifty Noon on X and subscribe on Substack. We will catch you on the next Deep Dive.